You're here because you've either just started your business or you're planning to start your business and you need money to get it off the ground. So let's go over all of your options to fund your startup. My name is Portia, and I've spent the last 6 years learning all the different ways businesses can get money to start and grow. I now specialize in SBA startup loans, but this channel is going to be so that you can understand all of the resources that are available to you and your startup business. Welcome to Startup Loan School. So there are 4 main ways that you can get funding for your business. You can either use your own personal funds, you can reach out to your community, you can seek out an investor, or you can get a loan. So let's dive into all of these options individually and go over the pros and cons. So the first option of using your own personal funds, like most commonly your savings account or your retirement accounts. So if people don't use this option, or if you don't want to use this option, right, most likely it's because you don't have it, you don't have enough of it, or you don't want to gamble with your own money. But this is the first option that we all have to start a business and grow a business. But if this one doesn't work for you, let's move on to reaching out to your community. So if you're going to reach out to your community, this is most likely going to be crowdfunding and grants. Now, a lot of times this is money that you don't have to pay back. So that's definitely a pro. However, with crowdfunding, these are individuals that you're reaching out to and you're basically asking them to invest in your business, believe in you. And it's hard to get individuals to part ways with their cash. As far as with grants, you're also asking people or programs and organizations to believe in you and invest into your business. But it's hard to find grants and they're highly competitive, and they also can take a while to actually get approved and get going. These options aren't the easiest to get. So if you haven't been successful with reaching out to your community, getting grants or getting people that you know to invest in your business, let's move on to option 3 of getting an investor. So if you're going to try to seek out an investor, this is either going to be an angel investor or a venture capitalist. Now, with an angel investor, this is going to be an individual that has money that wants to invest in your business in exchange for equity. And with venture capitalists, these are people that work for firms who have money, who will invest into your business for equity. Now, with that, it's just not easy, again, to get an investor to invest in your business, or I think more people would do it. And there are specific businesses they like as well. However, if this is for you, great. If it is not, we'll move on to the 4th option of financing, which is my favorite topic and also the most common way that people fund their business besides self-funding. So let's get into this. So there's personal financing and there's business financing. Personal financing does show up on your personal credit report. Business financing does not. However, contrary to popular belief, most business financing still has a personal guarantee, but we'll go into that in another video. So let's go over the types of personal financing that you can receive. There's a personal loan, there's HELOC, and there's personal credit cards. So with the HELOC, this is going to be a home equity line of credit, right? And you have to have a home and you have to have equity in that home in order to receive it. So you are using your home as collateral in order to get funding for your business. And some people may want to do that, some may not. But the good thing about a HELOC is they normally have really, really good terms. But again, not everybody has that option. So there's also credit cards. But with credit cards, although they are for the most part, they're easy to get, they may not give you all the cash you need to actually start your business. And again, it's not cash. So if you do need cash to actually put into your business, it's most likely not going to be from that credit card. And plus, credit cards do have, for the most part, high interest rates. And so if this is a long-term investment that you're seeking, this is not something that you want on your credit card and just racking up the high interest over the years. You shouldn't really use a credit card to fund long-term investments. A personal loan is cash. Now that personal loan is good because it's also fairly easy to receive as long as you have a job and decent credit. But with the personal loan, they do have higher interest rates than business loans, the good business loans, but it is an option. Now, if you don't want to go on the personal side and you want to go on the business side, well, let's go over some of your business financing options. So with business financing, it's going to break up into two categories. Business financing that you can receive when you are pre-revenue, and business financing that you can receive once you start making money with your business. So let's go into the pre-revenue first. You have four options. You have SBA loans, you have equipment financing, you have hard money loans, and you also have business credit cards. So with SBA loans, these are loans backed by the Small Business Administration, but they're still given out by banks and lenders, that you know of. It's just that bank and lender is more likely to give you money because it's being backed by the government. And startup loans are risky. So with the SBA, they're good because they normally have 10-year terms. And so you have payments that are stretched out and you have so low monthly payments. It's not going to suck cash dry from your business as you're trying to get started. But with that, the SBA does have a lot of hurdles in order to get into it. So we do help out on the SBA side, so I can help you with that. Now, the SBA is definitely a pro, but there's also other options. So you have credit cards, but with a credit card, it's not cash again. And business credit cards, as a startup, most likely you're not going to receive a large amount. So you may need more capital than what a business credit card can give you. And then on top of that, it depends what you're using it for. If it's a long-term investment, like you're not trying to pay it back right away, they carry high interest rates. Although they do have promotional rates like 0% for 12 months, maybe 24 months, but you're still over time going to pay back a lot of money using a credit card. So let's jump into equipment financing. With equipment financing, this is strictly for people that are looking to finance equipment. You can basically get a lender that will purchase that equipment for you and hold on to the title until you pay it off. And hard money loans, this is strictly for people looking for real estate investments. And that's the type of loan that you can get fairly easy as long as you can show some type of credibility on your part that you know what you're doing. So that's on the pre-revenue side. On the revenue side, when it comes to business financing, there's going to be four additional options. There's merchant cash advances, there's term loans, there's also asset-based financing using your real estate, and asset-based financing using equipment. So if we go into merchant cash advances, basically this is high interest, short-term debt, but you can get it in 24 hours. So if it's like an emergency for your business, you basically have this option, but it can suck your cash flow dry. So I would be very cautious before using a merchant cash advance. Next, you have term loans. So remember, SBA loans is a type of term loan, but the SBA is backed by the government. So with regular term loans, banks and lenders, they have all types of term loans that they have within their institution, right? They have their own minimum requirements. The government's not necessarily regulating these loans to a degree, but they can make the terms on this and let you know what it is. And so there's so many different types of term loans that exist within every bank and every lending institution. And a lot of times, if it's not backed by the government, then you have to already have made money with your business in order to receive it, because it's more so a risk factor. Now, term loans have better interest rates a lot of times than personal loans, but sometimes they can be neck and neck. But at least with the term loan, again, it's a business loan, and they do carry, a lot of times they carry longer term lengths than, say, a personal loan. So that's on the term loan side. There's also asset-based lending, right? And so with asset-based lending using your real estate, you have business lenders that will put a mortgage or a second mortgage on your property and basically give you a business loan. But again, now you are using your property. However, now that you have that collateral, you just have access to more money. So there's the same concept using your equipment. So you have equipment that's free and clear. You can get a lender that will put a lien on that piece of equipment, and then they'll give you a loan that way as well. So those are all of your funding options for your startup business. I can go into more of them. If there's one specifically that you want to know more about, just let me know in the comments. Or if there's one that you know of that I did not talk about, let us know in the comments. And if you found this information valuable, just make sure you hit that like button. And I'm going to share so much information with you guys that I have learned these past years with SBA loans and other types of business lending. And so that you can have all the tools you need to start and grow your business. So if you want this information and this is going to be helpful and valuable to you, make sure you subscribe. I'll see you in the next video.